You already know that the US and Israel are at war with Iran and oil prices are all the way up. But what does that actually mean for investors who care about their investments and how they perform in the stock market? Well, in this video, we're going to look at the historical impact of wars on the stock market, what the future outlook is for this specific war on the stock market and the global economy, some of the impacted sectors that do well and not so well during times of war and recession, and how I'm positioning my portfolio. Let's get into it. So, what does war actually mean for the stock market? Not much, at least for now. Well, what I mean by that is that the historical impact of wars is that it causes short-term shocks which leads to sell-offs, and the market typically ends up recovering and stabilizing after a couple of months or a couple of years. My research tells me that you need to have the mindset of a long-term investor. Long story short, unless the war's happening on the US soil directly, you don't need to really worry too much. And with your portfolio, well, if the war isn't directly disruptive to your company that you're invested in, or companies that you're invested in, their supply chain or the markets that they trade in across the globe, then you're good for the most part. Typically, the best sectors that do well during wars are defense and energy stocks. Naturally, the government ends up pumping money into these sectors in order to build more military resources. I don't want to say the actual words in case it, demonetizes me. And they get government contracts as a result. Energy stocks also rise as a result because increased manufacturing it leads to an increased demand for oil and natural resources. The worst sectors, on the other hand, end up being consumer discretionary goods. So anything that's non-essential, anything that's luxury, people tend to bunker down during wars. So you need to think about that when you're positioning your portfolio. And lastly, investor behavior. Well, people tend to overreact to every single news story. The stock market can become very volatile, and that ends up creating opportunities to buy great companies at fair or terrible pricing. Terrible as in very cheap. So take a look at this graph, which shows the performance of the stock market after several significant wars and global events. You see that typically in the weeks that follow, the stock market dips quite significantly at times, but then a year later, it's rebounded, if not more so than the initial dip that investors experienced initially. Like, look at the Pearl Harbor attack, down 20%, up 11% a year later. Look at the Cuban Missile Crisis, down basically 7%, and then up 32% a year later. Kennedy's assassination, 3% down, and then up almost 30%. The Iraq invasion of Kuwait, 17%, and up 14% a year later, and so on and so on and so on. And to hammer this home, let's look at this chart, which plots the S&P 500's performance over the last almost 100 years. Well, as you can see, it's up ridiculously since 1927, all the way to 2020-24. And each step of the way, you see that, yes, wars do cause a mini blip, but the stock market recovers. So what I'm trying to tell you guys is, relax, breathe. It's not the end of the world, unless it is. But then that's a different story to worry about. Now, let's look at the future impact of this war and what it might mean for the stock market that we're actually in. Ladies and gentlemen, the news is fear-mongering, so keep calm and be an eagle. I'll tell you more about that later in the video. No one knows how long the war is going to last, but what we can do is make educated decisions and about how we structure our portfolio and buying decisions to put ourselves in the best position possible. Look, a couple of facts about this war. Iran, they're a massive oil producer. They have 4% of the world's oil reserves, and they export the majority of that to China, over 90%. Due to US sanctions, stopping them from being able to export it anywhere else. What this means that any disruption of Iran's oil imports to China means that the cost of production and raw materials goes up for Chinese manufacturers, which could place a knock-on effect on the rest of the global economy. Key fact number 2, the Strait of Hormuz. This is just a strip of water that connects the Persian Gulf to the rest of the world. Why is that important? Because 20% of the world's oil passes through there, and Iran has closed that. This means that the world is currently down 50 million barrels out of 100 million barrels that it needs a week, which is driving up oil prices. They're up about 60% higher than they were before this war started. and any prolonged closure of the strait poses poses a risk of increased oil prices in the future. And economists estimate that oil prices could end up skyrocketing past $150 per barrel. So why is that important? Because it directly impacts everything. Listen, point number 3. Oil and the cost of oil impacts everything in life. If oil prices go higher, everything goes higher. The cost of fuel, energy, and end products for the end consumer, the cost of doing business, and the cost of living increases. Cost push inflation is the economic term when the cost of factors of production rise. This ends up increasing the cost of production, and therefore producers, yes, businesses that sell to other businesses or businesses that sell to consumers, end up passing these higher costs onto the end consumer. Increased prices means that consumers have less money to spend, leading to lower demand because not everyone can afford as much as they used to be able to, which leads to lower sales and lower revenue, and therefore lower earnings for businesses, which hurts their performance. For consumers, on the other hand, they end up having less discretionary income, which means that they're going to tend to move towards saving their money rather than spending their money, which ends up slowing down economic growth at a macro level. So GDP gets hurt as a result. It's also important to remember that the stock market isn't the economy. It's rather a proxy for how investors feel the economy is going to do in the future. Now the VIX, which is a volatility index and is a proxy for how confident investors feel the stock market is going to perform, is at 26. Why is that important? Because typically, if the score is anything below 12, it means that there's extremely low volatility. Anything between 12 and 20 is around about stable market conditions. Anything between 20 and 30 means that there's a bit of elevated volatility and uncertainty in the market, which tends to pose a little bit of concern. And anything 30 plus, well, that signals panic and heavy sell-offs and fear in the market and blood in the streets. But you know what they say, when there's blood in the streets, there's greed in the sheets. They don't say that, I made that up. Anyways, at 26, it's starting to show that investors are getting a bit shaky in the market. However, when you look at the S&P 500, since the time the war started till now, it's only down about 2%, which shows that investors aren't completely spooked. Another thing to consider about for the future is that the IEA, which is a group of countries that have a lot of oil reserves stocked up, they've released 400 million barrels of oil to make up for that 15 million barrel shortfall. Well, let's do some maths. 400 divided by 15 equals 26. 26,666, whatever. They've basically got a month's worth of reserves if they were to release that all at once. They could release it in drips and drabs, and that would help stem the increase in oil prices. However, when they did do this, oil prices went back up because investors aren't completely buying any of these puts. So it's important to monitor if there's any signs of a prolonged blockade of the Strait of Hormuz. If that's the case, then we can start worrying about the global impact. Yes, oil prices that rise today won't typically impact inflation because obviously there's still oil in the global economy that's already been bought at lower prices. It will take some time to reflect in our day-to-day lives. But if there is a prolonged closure, then we can start worrying. Moral of the story, keep some cash around because there's going to be some opportunities to buy. So, what are the impacted sectors that do well and not so well during times of war? Well, I already said, energy and defense stocks. If you check some of the most popular ETFs that cover energy and defense, they're up, some over 20% since the war started. And you know this is the case because prior to this, they weren't performing too hot. Sub 10%, which is below the performance of the S&P 500 for last year, around 20%. What's already happened is precious metals already up in value. Gold, silver, copper. Yes, investors are fleeing to safety because typically when there's expectations of high inflation, investors tend to flee to stable, hard, real commodities. And these precious metals are already up, some over double in the last year. Gold up 70%, silver up 150%, lithium up 111%, platinum up 113%. Yeah, it shows that investors are a bit skeptical and are feeling a bit shaky about how that stock market is going to perform. So they want a bit more stability as a hedge against inflation. and a hedge against the impact of this war. In the future, let's say this war lasts and there's prolonged conflict that leads to recession. Which sectors do bad and which sectors do well? Well, the worst performing sectors tend to be anything that's non-essential, consumer discretionary. Things like high-end food and beverage and clothing, cars in the automotive industry, travel and leisure, hospitality. Yes, all of these will take a very big hit if there's a prolonged conflict. Stocks like Ford and GM, who produce cars, Wynn Resorts and Hilton, who have owned massive hotel chains, Boeing and IAG, which, which produce airlines, and cruise stocks. My gosh, it's already expensive enough to go on a cruise. Do you think they're going to be having any cruise when people are facing recession? Nah. And last but not least, Starbucks. My guys, yes, Starbucks. Have your parents never told you that there's coffee at home? Because there is. On the flip side, sectors that do well, consumer staples, things that are needed, necessities, and things that customers are already addicted to that don't break the bank. Things like consumer staples, healthcare, affordable luxury items. Companies like Amazon, yeah, I know, you're not giving up that Amazon membership. You're addicted to that next day delivery. And the prices don't necessarily break the bank. Netflix, yep, that did amazingly during COVID. People weren't going out, and people can't afford to go out. So what have they got to do besides watch movies and endless series at home? With all for just $15.99. Probably like $25.99 in the next year if this inflation goes up. Walmart, P&G, Pepsi, Coke, all these companies, they're not necessarily the most flashy companies, but they're stable. They're affordable, well-known household brands, and that's what people are going to be flocking to when their income doesn't go as far due to recession. If there's job losses, people are going to be looking at how to save money rather than spending it. And companies like McDonald's, my gosh, yes, this behemoth. They recently released that $5 or pound meal deal. Sweet money worth. If those who know. They'll also do well. So moral of this story, be an eagle. Open your eyes. Not everything that glitters is gold. Soar from the skies and dive down when you spot an opportunity and grab it with your two big talons. Final section, how I'm personally investing. What's the game plan? Well, with all that being said, I'm going to keep calm. Yes, panic is your enemy. Calmness is your friend. But with that being said, I'm too going to be investing with caution. Not everything that glitters is gold. 3, I'm going to be keeping a bit more cash around because if this conflict is prolonged and it does end up spooking investors even further, and there is a big sell-off, I want to be able to take advantage of those opportunities. Which leads to 4, I'm going to be buying the dips. Yes, I'm not going to dump all my money in the market all at once. I'm going to be possibly waiting for better opportunities that come from the market. Stock market's already at quite high valuations already. 5, I'm going to be monitoring government spending and Fed policy because that will determine the type of investing landscape that we're in, whether it's a risk on or risk off market to a large extent. 6, I'm going to be checking for signs of a prolonged conflict because that will also impact how confident investors feel about the economy and stock market's performance in the future in the long run, and whether that's probably going to trigger a global recession. And 7, I'm going to be taking advantage of any oversold buying opportunities in strong companies that investors are fearful for. Now, let's look at 2 things, the macroeconomic numbers and then numbers in relation to the stock market, because this will bring us to life. Well, we're currently in an overpriced and uncertain market, and investors, again, are overreacting over every single bad news headline and looking for a reason to sell. The stock markets and many tech stocks and sectors have already ran up massively. So I'm not surprised if investors want to take profit at this stage. If we look at our Fed chessboard, we're seeing that interest rates aren't being cut, currently being set at 3.75%, and their balance sheet is increasing. They're purchasing short-term T-bills, which is driving up the price and decreasing the yield. So this should push investors to look for better returns in the stock market. However, the political climate is still a bit uncertain. And funnily enough, because these yields have fallen, the Treasury has been forced to issue new bonds at higher yields in order to account for this uncertainty that investors are facing due to higher fears of higher oil prices and the potential impact on inflation. Investors are a bit bullish but still scared for the short-term impact on the economy, and are waiting to see which direction the overall conflict goes. One thing to note is that the yield curve that comes with Treasury bonds is currently an normal curve. If this starts to flatten or even invert, it will signal bullish sentiment for the US economy, because investors are purchasing long-term bonds far more than they are for short-term bonds, which is driving down the yields. So the yields for long-term bonds are lower than they are for short-term bonds. So investors are more bullish for the future, not so bullish for the short term. And funnily enough, this is signaled quite correctly the last few stock market crashes and recessions. Other things to look at is unemployment. Since 2019 and the big thing that happened there, it's stable, and in recent months it's at 4.4%, which is within the Fed's 4 to 5% range. Non-farm payroll was down 92,000 in February, which isn't very significant. That means that there's 0.006 fewer jobs, but there's over 160 million individuals employed in the US economy. Initial jobless claims were at 213,000 for the week of the 9th of March, which is down 1k versus the previous week, and lower than the 215,000 forecast. CPI has been relatively stable at 2.4% versus the 2% Fed target, but the impact of higher oil prices will take some time to reflect. GDP growth was 2.2% for the full year 2025 and a 2.5% target for the year of 2026. Let's see what oil prices and the war in Iran end up doing. Any slowdown in this will shake investors' confidence, and that might also contribute to a sell-off in the stock market. Now let's look at how the stock market is performing recently. So the VIX is currently at 26. So the market is fearful. If it crosses 30, it's in full panic mode. This signals high uncertainty, and there are risks of sell-off in certain sectors. The Schiller PE ratio, which is basically an average of the S&P 500 PE ratios over a longer period of time to account for booms and busts in the stock market. It's currently at 38.5, which is much higher than the historical average of the 25 to 30 PE range. Now, when we look at the big indices within the US stock market, we see that the S&P 500 is down 2.71% year to date. However, it's still up over 19% year on year. The Nasdaq is also down almost 4% year to date, but it's up 26% year on year. The Dow Jones is down 3.5% year to date, but it's up almost 13% year on year. And the Russell 2000 is currently down 0.77% year to date, but it's up 22.82% year on year. So what this tells us is that the stock market is still at relative all-time highs compared to past performance. However, it's starting to see a relative pullback in the market. So investors, I would say we're currently in a risk-off market. So moral of the story, guys, stay frosty, make money, ice in your veins, relax. As long as you have a job and that job is stable, as long as you have income and cash around and you can pay your bills, you're not living above your means but below your means, you will be fine. If you've got an emergency fund, yep, good, you will be fine. Keep cash around, take advantage of opportunities. With that being said, silent wins, signing out.